Good morning. My name is Hombu. First, I would like to start off by thanking you all for taking the time off your busy schedules to attend today's earnings briefing. To all of you gathered here, stockholders, institutional investors, analysts, financial institutions, stakeholders, I would like to thank you for your continued support and loyalty. I would like to start today's presentation by presenting the highlights for the second quarter of the fiscal year 2018. Continuing the trend from the first quarter of the financial year 2018, we achieved both an increase in operating revenue and operating profit. In particular, we saw growing demand both in the domestic financial business and the financial business in South Korea. As a result, we recorded 4.1 billion yen in operating profit for the first half of the fiscal year of 2018. Please turn to the next page. In addition to an increase in both operating revenue and operating profit, we were also able to deliver a profit for the second quarter of the fiscal year 2018 in net income and EBITDA after adjustment YOY. I would now like to take a closer look at each individual accounting metric, starting with operating revenue. This metric stood at 38.9 billion yen for the first half of the fiscal year of 2017. We've managed to increase this figure to 41.4 billion or 6% YOY. As you can see from the slide, operating revenue for the three main financial segments, which are the domestic financial business, the financial business in South Korea, and the financial business in Southeast Asia, increased by 4.5 billion yen YOY. Regarding the metric of operating profit, we reported 20-fold increase YOY from a mere 200 million yen for the first half of the fiscal year 2017 to 4.1 billion yen for the first half of the current fiscal year. The following slide contains our profit valuation excluding valuation reserves. We expect this value, which stood at 6.3 billion yen for the full fiscal year of 2017, to grow to 10 billion yen for the fiscal year of 2018. This translates into a 59% increase YOY. I would now like to explain our performance and results by segment. As you can see, the financial business in South Korea added a significant chunk of 3.9 billion yen in operating revenue. Please turn to the next page. Unsurprisingly, our operations in South Korea generated an additional 1.2 billion yen YOY in operating profit. Additionally, we registered an improvement to the tune of 2.6 billion yen in the financial business in Southeast Asia. While this wasn't enough to turn a profit, it was a marked improvement nonetheless. I would now like to direct your attention to the next slide. It provides a comparison of the first and second quarters of the fiscal year of 2018 in terms of operating profit. As you can see from the item labeled total, we booked 2.5 billion yen during the first quarter of the fiscal year 2018 from April to June. This figure dropped somewhat to 1.6 billion yen during the second quarter of the fiscal year 2018 from July to September. The reasons are as follows. We see two main reasons for this decline. First, if you exclude a provision for doubtful accounts to the tune of 600 million yen returned to us during the first quarter of the fiscal year of 2018, we register 1.9 billion yen in operating profit during the first quarter of the fiscal year 2018. This leaves a 300 million yen discrepancy, which corresponds to an adjustment to the book value of J-Trust Investment Indonesia, or JTII. When you exclude these one-time non-recurring events, it becomes clear that we have been successful in the stable generation of profits. I would now like to have a closer look at the performance results for each segment, starting with the domestic financial business. Starting with the item of operating revenue, we posted a 7% increase YOY from 4.6 billion yen for the first half of the fiscal year 2017 to 4.9 billion yen for the first half of the fiscal year 2018. In terms of operating profit, we took a slight hit from 2.6 billion yen during the first half of the fiscal year 2017 to 2.4 billion yen for the first half of the fiscal year 2018. However, if you exclude 500 million yen out of 2.6 billion yen from the gain on asset sales recorded in the first half of the fiscal year 2017, we actually grew during this period from 2.1 billion yen to 2.4 billion yen. I would now like to refer you to the next page. This slide contains an overview of the key performance indicators for the domestic financial business. As you can see, the amount of credit guarantees secured by Nihon Hosho stood at 112.1 billion yen as of the end of September 2017. This represents an increase YOY of 72%. The portion of the vertical bar chart colored light blue corresponds to apartment loans worth 71.2 billion yen. We have taken precautions to mitigate our risk exposure to these loans by being extremely selective in our choice of properties. So for example, we only deal with properties situated in major urban areas, namely Tokyo, Nagoya, Osaka, and Fukuoka. And even then, we focus exclusively on conveniently situated areas with direct access to public transportation. Finally, we also only deal with reputable and reliable property management firms, allowing us to guarantee occupancy rates in excess of 98%. We currently guarantee approximately 1,000 such loans, and in 4 years we haven't had a single borrower default on their loans. Moving on to the servicer business, our amount of receivables stood at 759.2 billion yen, which translates into a 5% increase YOY. Finally, I would like to present our projections for the current fiscal year. In terms of operating revenue, we posted 4.9 billion yen during the first half of the fiscal year 2018, which translates to about 46% of the projected amount of 10.7 billion yen for the full fiscal year. For the metric of operating profit, we achieved 2.4 billion yen, or 52% of our stated goal of 4.6 billion yen for the fiscal year 2018. I would now like to have a closer look at the financial business in South Korea. In terms of operating revenue, it grew at a healthy pace from 13.5 billion yen during the first half of the fiscal year of 2017 to 17.4 billion yen for the first half of the fiscal year 2018. This represents an expansion of approximately 29% YOY. Regarding operating profit, we'd register a twofold increase YOY from 1.2 billion yen during the first half of the fiscal year 2017 to 2.4 billion yen for the first half of fiscal year 2018. Delving a little bit deeper, even if you exclude the aforementioned provision for doubtful accounts to the tune of 600 million yen returned to us during the first half of the current fiscal year, this still leaves us with a healthy 1.8 billion yen. The data indicates an increasingly profitable and sustainable model. Next, I would like to take a closer look at our loan balance and delinquency ratio of non-performing loans for JT Chinai Savings Bank. JT Chinai is our flagship bank in South Korea. We started with assets of approximately 30 billion yen back in 2012. By October 12, 2017, the bank's 5th anniversary, the loan balance at the bank grew tenfold to reach 300 billion yen. As you can see from the graph, the darker part of the graph was accumulated by our own credit screening. As a result, the delinquency rate remains contained at 5.47%. The actual figure is a lot lower because debt consolidation through the court bankruptcy process, which will be repaid in the future, is counted as a debt delinquency event. If you exclude these, the effective rate is actually just below 3%. As I'm sure you're aware, there has been a steady trend toward lower interest rates and increased government supervision in this area. More specifically, there are plans to lower the ceiling on interest rates charged by banks from 27.9% to 24% by February 2018. We intend to leverage our experience dealing with increased financial regulations following the financial crisis of 2008 in the market in Japan to thrive and further expand our operations in South Korea. We achieved 17.4 billion yen in operating revenue during the first half of fiscal year 2018, or 51% of the total amount of 34.1 billion yen projected for the full fiscal year 2018. And also, we achieved 2.4 billion yen in operating profit during the first half of the fiscal year of 2018, or 75% of the total amount of 3.2 billion yen projected for the full fiscal year of 2018. I would now like to proceed to the financial business in Southeast Asia. In terms of operating revenue, we registered a 6% increase YOY to 7.2 billion yen. As it pertains to operating profit, we registered a loss of 200 million yen, which, while still a loss, represents an improvement of 2.6 billion yen YOY. If you watched our last earnings briefing, you might remember that we posted 200 million yen in operating profits for the first quarter of fiscal year 2018. The financial business in Southeast Asia comprises of the BJI, which stands for Bank J Trust Indonesia, or JTII, or J Trust Investments Indonesia. This 200 million loss during the second quarter of the fiscal year 2018 is due to a non-recurring event involving a downward adjustment to JTII's book value by having reviewed the collection plan. JTII has started their business almost 2 years ago and collected on a large portion of transferable receivables, with the exception of 4 non-performing loans, which we have to change the collection plans recorded downward adjustments to JTII's book value. As I've said, this is a non-recurring event. I'm sure some of you will think 200 million yen is simply a provisional figure that will balloon out of proportion over the next few months, but the reality is that it was recorded under IFRS accounting. Under Indonesian accounting standards, we actually grew for the 9th consecutive month. We have an impeccable reputation with the OJK, which is the Financial Services Authority in Indonesia. This international financial reporting standard for provision of doubtful accounts is particularly stringent, so that we can confidently say our current account balance for our bank has improved significantly. How can I be so confident, you might ask? First, there's the fact that upon acquisition, BJI has succeeded in collecting non-performing loans and reshuffling the loan portfolio. Furthermore, we carefully examined the credit worthiness of prospective borrowers in-house for nearly half of all loans provided by BJI. This allows us to assure these loans are repaid on time, which in turn allows us to keep delinquency rates low. This section deals with 3 metrics, namely net interest income, the CASA ratio, and COF, or cost of funds. COF has been steadily going down. As you can see from the graph, we're down to 7.19% from a high of over 9% when we first acquired BJI. The same goes for our CASA ratio. The CASA ratio is defined as the ratio of current and savings account, which have lower interest payments, to total bank deposits. As of the second quarter of the fiscal year of 2018, BJI's CASA ratio rose to 12.24%. We also registered 108.8 billion rupee in net interest income. Some of you may worry that this metric has seen a contraction. Although this is true, it is completely in line with our expectations. Delving a little bit deeper, this apparent contraction is due to strategic repayment of loans from our large institutional clients. That's exactly what happened in June, leading to an immediate reduction in our loan balance and consequently to a reduction in net interest income. However, if you look carefully at the monthly data, you'll see that the months of July, August, September, and October mark the beginning of a reversal towards an increase in our loan balance. Please now turn on to the next page. This slide pertains to the activities of Group Lease Finance Indonesia. In terms of points of sale, we counted 92 locations as of October 31st of this year. This represents a twofold increase from June. Not just that, as you can see from the map, it is a very even and comprehensive geographical distribution. As a result, we saw explosive growth in GLFI's loan balance, which surpassed 200 billion rupee from over 7,500 customers. Particularly popular are group loans and microfinance loans. Regarding the operations of BJI, we recently opened new branches inside Ion Mall in Jakarta and in the Karawang region. The Karawang region is an industrial area servicing mostly, up to 80%, Japanese companies. We opened a new branch in the region which is attached to a cafe as part of our growth strategy. In addition to this, we've also had success with a TV commercial featuring a Hollywood celebrity. In terms of operating revenue, we booked 7.2 billion yen, or 43% of our stated goal of 16.7 billion yen for the full fiscal year of 2018. Regarding the operating profit metric, we have slightly less than a 6-month window to meet our target of 2.4 billion yen. We took a conservative approach by having reserved a provision for doubtful accounts in the previous fiscal year. So if we can collect a number of NPLs to improve the quality of loan assets, we can expect some reversal of the reserve from now on. But now we have to make up for lost time. We intend to do this by first strengthening BGI's core business. How do we go about achieving this? By, for example, expanding our loan balance and by guaranteeing the collection of NPLs. Also through the acquisition of qualified human resources, allowing us to open new branches with optimal efficiency. Another major change we plan to implement is a radical revamping of our core banking business. We expect the new system infrastructure to be operational by January 2018. This infrastructure will allow us to increase efficiency in mobile and internet banking, allowing for the collection of interest payments in low interest-bearing savings account. Not just that, but we also intend to develop international remittance solutions leveraging the use of blockchain technology. In addition to blockchain distributed ledger technology, we also intend to make use of fintech to allow for P2P loans and of cloud accounting software to streamline SME loans. Our two core strengths of J-Trust are a combination of speed and flexibility. There are over 120 commercial banks in Indonesia, but we intend to capitalize on our strengths and raise above our competitors. We at J-Trust will continue finding new ways to innovate. You won't find this information in the slides, but we're currently in talks with a number of regional banks in Japan about a possible business matching arrangement of their SME customers, whereby BGI offers assistance to them, hoping to gain a foothold in the Indonesian market. Regarding our servicer business operations at BGI, we need to resolve the issue of the 4 non-performing loans as soon as possible, for example by selling long-term overdue receivables to third parties. I would now like to provide you with an analysis of our investment in non-financial business operations. In the interest of time, we've bundled everything into a single slide. As you can see, in the investment business, we reported 1 billion yen in operating profit, while posting a 200 million yen loss for the non-financial business. This was caused by a delay in the release of our line of amusement machines, but we are gradually seeing a return to profitability going into the second half of the fiscal year of 2018. Going back briefly to the investment business, I know some of you are worried about our exposure to Group Lease PCL stock. We have received many inquiries regarding our relationship with Group Lease moving forward. Mr. Fujisawa, President and CEO of J-Trust, shall be addressing these concerns in his presentation. Finally, I would like to provide a brief outline of our projected earning targets for the full fiscal year of 2018 on a consolidated basis. In terms of operating revenue, we booked 41.4 billion yen during the first half of the year, or 46% of the 89.4 billion yen projected at the end of the second half of the fiscal year 2018. Regarding the metric of operating profit, we are currently at 41%, namely 4.1 billion yen out of a 10 billion yen goal. As I've stated multiple times in this presentation, the financial business continues to grow at a very healthy pace. We are fully committed as a fully unified entity to our target for the full fiscal year of 2018, beginning with a return to profitability for the financial business in Southeast Asia. This concludes my presentation. Thank you for listening. Good morning, everyone. My name is Fujisawa, President and CEO of J-Trust Corporated Limited. I had originally planned to cover a number of different topics, but I'll keep it brief and focus on the current situation with Group Lease PCL and our relationship with the company moving forward. Group Lease PCL is active in Southeast Asia and has managed to expand its operations in countries such as Thailand, Cambodia, Laos, Myanmar, etc., through the creation of an extensive network of small branches referred to as points of sale. They're mainly providers of consumer loans, for example, for the acquisition of motorbikes or agricultural equipment. They've also made inroads into the business of microfinance lending and are currently deploying centralized inventory management and accounting solutions in countries such as Myanmar. So Group Lease PCL is a real company with real achievements. It is also a publicly traded company in Thailand. Last year, it outperformed every other company in the stock exchange in Thailand, while this year it holds the distinction of worst performing stock. As I've already outlined, it has a number of things going on for it. Its ability to expand its point-of-sale network with Honda and Kubota in Cambodia, exclusive rights for Honda motorbikes in Myanmar, etc. If only this unfortunate incident hadn't taken place, I'm sure they would have continued posting excellent results. We have launched a joint stock company with Group Lease PCL in Indonesia and used their POS in around 130 stores or branches. For example, to provide microfinance loans or installment loans for the purchase of motorbikes or agricultural equipment, such as pickup trucks of Tata. We're also currently in the process of providing similar loans to fishermen who need to buy fishing boats. As I've said before, it's a rapidly growing market. It's a mutually beneficial relationship. They, and by they I mean the joint stock company, brings in new customers and performs the necessary credit background checks, while we, the bank, achieve a nice return on deposits. It was amidst this backdrop that the SEC filed a criminal complaint with the Department of Special Investigation in Thailand against the CEO of Group Lease PCL, Mr. Mitsuji Konoshita, on October 16th. He stands accused of corporate fraud and falsification. I might have previously mentioned about the question transaction, and I still don't know if what they did is wrongdoing, but the truth is that the SEC filed the complaint against them, and that is a fact. In all honesty, I'm not in a position to decide. Structurally speaking, it's a situation that is reminiscent of the Live Door scandal from a while back, in the sense that both were top-performing stocks one year to fall to the absolute bottom of the list the next. I bet Mr. Horiemon and others involved in the Live Door scandal had no idea that what they were doing was illegal, and I think the same can be said for Mr. Konoshita and others involved. The truth, though, is that the SEC is mounting a criminal case against the company, and there is nothing we can do to change that. So I got in touch with Mr. Konoshita immediately after the news broke out, and for the next 3 or 4 days we deliberated on our contracts. We didn't take an adversarial position towards them, and they weren't hostile or aggressive towards us either. We hold $180 million in Group Lease convertible bonds, which corresponds to about 60-65% of their total liabilities. This criminal complaint means that the bond covenant will, or already has been, violated. It's a shame because it obliterates any chance for future growth for Group Lease PCL. In the non-banking business, access to capital is of the utmost importance. As such, should Mr. Konoshita remain at the helm, I don't see how the company would ever be able to further expand its business on their own. It is truly unfortunate because although they have other financial penalty issues pending in a Japanese court, which is an administrative litigation, but this criminal complaint changes everything. So we have come to the sullen realization that it is no longer possible to continue our partnership with Group Lease PCL. As a publicly traded company, we cannot risk being associated with any type of illegal behavior. So how do we guarantee a solution that offers the most benefit for both Group Lease PCL and J-Trust? We've outlined a few scenarios in a press release we put out yesterday, and we're currently exploring case number 3, which involves turning Group Lease PCL into a wholly owned subsidiary of J-Trust. There are other parties involved. For example, like the Honda dealership in Cambodia or the people in Myanmar providing installment loans for motorbikes. They also have major shareholders in Sri Lanka, as well as the people working at Group Lease PCL. So if we decide to go down this route, it won't be an easy decision by any means. We would like to find an amenable solution involving a business merger that would benefit everyone, but there's always a chance we won't be able to reach an agreement. We have decided to wait until the end of November to give them some time to see whether they'll be able to release their earnings report or not, by which point we'll have a little bit more information. If we see things have settled down a little bit, then we'll try to advance with what we termed case number 3 on our press release. If we see there's no possibility to follow through with this option, or if there's no interest on their part, we've made our position clear that we'll simply have to go our separate ways. My personal opinion aside, the status quo simply isn't sustainable with the owner of a company that's under criminal investigation. So, to use what I think is an apt analogy, our companies either get married or we each go our separate ways. In the event of a divorce, so to speak, I'll inform you as soon as we reach such a deliberation. We put out a statement in our press release yesterday outlining the current situation, which is as follows. We currently hold 8% in common stock. 6% of this we converted at a rate of 10 Thai baht per share. Group Lease is currently trading at around 7 to 8 baht, which represents a big loss for J-Trust in the vicinity of 20%. Regarding the remaining 2%, we bought them in the open market, bringing the total to 8%. In addition to this, we also subscribed first to $130 million in convertible bonds, followed by another $50 million. Furthermore, our non-banking business in Indonesia was structured in such a way that Group Lease would provide the know-how and expertise, while we would be providing the capital. In other words, the arrangement we have with GLFI is similar to what we have with Nihon Hosho, which is one of several companies we have in the domestic financial business. Japanese banks lend money to customers, and Nihon Hosho guarantees those same loans. We employ a similar scheme in Indonesia, with an equity method wherein Group Lease owns 80% of the business and we own the remaining 20%. Like I've just mentioned, we received $180 million in convertible bonds, but since the covenant for these bonds might have been violated, these now have turned into debts. In addition to this, GLFI is an incorporated joint venture. We have made our position known that we would like to resolve the situation in as smooth a manner as possible. So, for example, if we choose to go down the route of either Case 1 or Case 2 as outlined in the press release, well, the results are identical, in the sense that if we stop authorizing loans to GLFI, everything will grind to a halt, obviating any of the current set of incentives for Group Lease. At this point, we turn it into a wholly owned subsidiary and continue to expand the non-banking business on our own in Indonesia. This means we'll be going our separate ways, so at that point, we will be selling our stake in Group Lease. At what price, you might ask? It depends on how the situation involving our convertible bond holding is resolved and whether a shareholder-derived lawsuit comes into play or not, but we feel we need to negotiate these terms in such a way as to limit our losses to the least possible amount. Regarding the issue of the convertible bonds, following case number 1, it would appear we are currently in agreement that a covenant violation occurred, which allows us to recover our money. The most peaceful solution would be to create a payment plan where they pay us back with their current cash holdings combined with an asset sale. Should they refuse to honor their obligations, then we'll have to resort to litigation, as we feel there'd be little point in attempting to reason or negotiate with the other side if things came to that. The board at Group Lease is composed of very talented and rational people, so I think that situation will never materialize. Another possibility is a capital infusion into Group Lease by a third party. This would trigger a change of control, allowing us to recover the full amount. Group Lease, too, is a publicly listed company, so they'll be in talks with the SEC and the SET, so our highly capable lawyers will be a contact point for them, and perhaps we will consult with the Japanese SEC, which might help as well. Furthermore, regarding the issue of a shareholder-derived lawsuit, we watched the whole LiveDoor incident unfold in close proximity. Not just LiveDoor, but the fraud going on at Incubator Bank of Japan. We watched that unfold too. And now Group Lease? This is no laughing matter. And having seen previous incidents unfold, Mr. Chiba and myself, personally, we would prefer for Group Lease not to go down that path. We, as a company, would like to ascend to the first sector of the Tokyo Stock Exchange, and we feel the current issue with Group Lease constitutes a big obstacle that needs to be addressed and resolved proactively. Mr. Hombu already covered this in his presentation, but we're seeing growth in the Japanese business, in the South Korea business, and in the Southeast Asia business. The South Korea business in particular has really started to blossom recently. I'm based in Singapore, which stands right at the center of JT's investment business. I consider the current issue with Group Lease to be my responsibility. I intend to commit myself to maximize profitability for JT while at the same time minimizing losses. In the event of a business merger with Group Lease, I am committed to finding a solution that won't hurt retail investors in Group Lease. I've acquired a great deal of experience dealing with difficult situations most people never have to contend with in their lives. I intend on making use of that experience and turn the difficult situation we're dealing with right now into an opportunity. Should this business merger go through, I'm confident we'll see the JT Group blossom in Southeast Asia and deliver results in the field of retail finance. Should we each go our separate ways, we'll have to focus our efforts in Indonesia and grow from there. The Indonesian market has great potential. Regulators in Indonesia have praised our bank, which we figured would take 5 years to restructure, when in fact we were able to do this in just 3. Not just that, we have other things going for our bank in Indonesia. We started using TV commercials, for example. Not just that, cost of funds has been going down, and we hope to be able to start converting our core system to create the infrastructure for online banking for retail customers, further reducing the costs. This is relevant because the loan balance is around 100 billion yen, and the cost of fund reduction of just 1% translates to 1 billion yen added to our bottom line. By continuing to increase our balance and by reducing costs, we'll be able to grow further. Maybe not exponential growth, but I think we can expect a nice upward curve. In regard to Group Lease, the ball is in their court now. We'll see what they decide and act accordingly. I expect Group Lease to act in a rational, level-headed manner, allowing us to reach an agreement that will be beneficial to both parties involved. What cannot happen is a continuation of the status quo, regardless of whether a business merger takes place or whether each company goes their separate ways, lest we risk being completely shut off from any chance of getting listed on Section 1 of the Tokyo Stock Exchange. This concludes my presentation. Thank you for listening.